Yeah, well, the president as well is really liking what he is seeing in the economy. He tweeted last night about the economy. Here's what he said. The U.S. economy looking very good. In my opinion, even better than anticipated. Companies are pouring back into our country, reversing the long-term trend of leaving. Unemployment numbers are looking great, and regulations and taxes have been massively cut. Jobs. But let's take a look at futures this morning after the long holiday weekend for President's Day. We're actually pointing right now to a much lower open. Dow down by almost 200 points in the pre-market. S&P, NASDAQ as well. Let's bring in Jonathan Hoenig, capitalistpig.com, to kind of talk about this. Jonathan, good morning. So, the president's tweeting last night how great things are, and then we wake up to potentially a big sell-off this morning. What do you make of it?
Yeah, well, listen, the president is right, Cheryl. I mean, the economy is strong. Jobless numbers are good. The thing to remember, however, is that the market anticipates the news. It doesn't reflect it. And in fact, the fundamentals are almost always stellar just as a major sell-off or bear market begins. So the president's right. The economy is strong. But the market, especially evidence, as you pointed out, numbers seems to indicate there's still some worries on the horizon moving forward, given the run we've had.
Are you talking about inflation? We're looking at the 10-year Treasury over, it's about 2.9%. So even above that 2.8% kind of still gives traders jitters, no?
Cheryl, you are too young to even remember inflation. You have to be.
Oh, no, I'm not,
50.
but thank you. I remember the 70s.
You have to be at least 50, 60, 70 years old now to remember what inflation was like in this country 30, 40 years ago. We really haven't seen it. Today's stock investors haven't seen it. And one of the things on my screen this week is the government selling another $250 billion in bonds. This is the government expansion of the money supply, which causes the inflation. And as you said, interest rates are now rising, Cheryl, even faster than the Federal Reserve is raising them. I think that's going to be the market's real worried, despite the fact that we're seeing good earnings and low unemployment.
I've actually seen a lot of commentary overnight that is backing up exactly what you're saying, that the concern is with global banks. Global central banks are going to have to pick up the pace in interest rate hikes because of what we're seeing with inflation, not just in the U.S., though, Jonathan, around the world. That could spell kind of a pullback for global markets.
Well, we've seen a global stimulus initiative going back literally for the better part of 10 years when it comes to the U.S. and even longer when it comes to Japan and a lot of other economies, Cheryl. So, there's no question, I think, for that reason, this is time for caution. It's not just opinion. Look at the price action of so many of the stocks we've been talking about. Stocks and ETFs at 1-month highs now are names like precious metals, soybeans, the yen. All the stocks and ETFs at 1-month lows are all those bond-related investments. Doesn't mean I'm a hater, but I think now, especially given the fact that many Americans are in debt and already invested in the stock market, makes this a good time for caution rather than unbreached enthusiasm.
We were just pointing to a new study that shows that millennials are worse off than the Gen X, which is their parents' age. And to your point about the economy and things looking good, earnings were actually incredibly strong for 2017. If we're looking forward for earnings in 2018, Jonathan, do you see a positive story?
Well, if we see it, the question, Cheryl, where is it going to come from? Is it going to be those internet and technology-related stocks, the Facebooks, the Amazons that have really led the market for the better 5 or 6 years? We're not seeing it now. Another reason why I think now is a great time for most investors simply to sit on their hands.
Well, Jonathan, we're going to let you go, but I remember gas lines. I remember mortgages at 14 to 16%. Those were the days.
I don't believe it. I don't believe it.
Jonathan Hoenig, that's true. Jonathan Hoenig, thank you so much. Good to see you.
Thank you.